All right. Hey, hope you are doing well. We're wrapping up the week here, Friday. Want to share with you some of the things from this week, and most importantly, I know, kind of as a team, we continue to just focus on operations, continue to focus on improvement, continue to focus on the implementation for Premier Living US, our property management company. But again, kind of noteworthy of this week's news. You've got the inflation data that came in at 2.71%, higher than the 2.6 last month. In one of the previous videos we did, we talked about that inflation is going to be a bit more sticky. And part of it, look, again, I'm not trying to be political. I think for the country overall, Donald Trump being elected, he's got much more democratic, economic, business principles that, give the country a greater opportunity to, lean down the bloated government, reduce taxes, reduce regulation. These are all things that are good for the economy, good for overall, good for the improvement of the jobs market and all these different things. Now, again, there's different nuances. People say, oh, well, if he does tariffs and, that's going to, increase cost and, impact inflation. For inflation to continue to go down, things got to smooth out. And ultimately, as the economy's improving or doing better, it makes it for a more sticky situation, like the hurricanes and all that just hit. More people lost cars. I mean, Florida, good Lord, from Sarasota north up to Big Bend, all got flooded. So many cars damaged, many people replacing those automobiles. That makes an impact. This time of year, people are making year-end purchases, etc. So all these factors come into play. So on one note, as I shared before, I think it's a good thing for the overall economy and for the country that Trump has been elected. There are a lot of pro-economic and business policies and foreign policies that will no doubt be put into place that benefit everybody. That being said, the bond market has again responded with interest rates, on the 10-year hovering at that 4.2 to 4.3%. Off a little bit from their high of about 4.45 when he first got elected. But what does this all mean? It means that I think we're going to see a much more sticky interest rate environment. As we shared before, the neutral rate, which used to be, down at like 0.5%, is probably going to land somewhere between, 2.7 and 3.2 as a comfortable rate. The Fed next week they will move forward with their plan, I'm sure, to cut by 1/4 point. But then now they're going to evaluate what takes place, January, February, March, before the March meeting to see, how's the country doing? How's the job market, more importantly, doing? And if they feel that things are going well, they're going to take a much slower path to lowering interest rates. Now, that's on the overnight funds rate, which affects, variable bank loans, line of credit, credit cards, loan payments, things of that nature on autos. Your more mortgages with Fannie Mae, Freddie Mac, and 30-year fixed home mortgages are moved more in conjunction with the 10-year Treasury, and that's a market function. So there is a pathway in charting analysis, for the 10-year Treasury to be down, like at the end of next year, maybe in the 3s, but it's not going to move quickly. And so people that are like, oh, hey, rates are going to go down and it's going to be a big boost. It's like, it's going to be a lot slower than that. And I think if you're looking, you take a step back, we're probably ahead of us over the next 5 years or even decade in an ultimately higher interest rate environment. Now, that doesn't mean that you couldn't have a recession and then the response to that is to cut rates. The bond market rallies, yields go down, slower economy, that happens. But I think overall, we're going to see that we just came off of, darn near a 40-year run in a declining low interest rate environment. We're going to have higher interest rates. Now, again, what does that mean for investing? So in real estate, even a semi-stable environment is a good thing because, again, even if the rates are hovering around 5, there's a new equilibrium to what that means. And, if we're buying a property and operating it, and executing on it and increase revenue by 40% over a 3-year run or 2-year run, and interest rates remain relatively stable, that has yielded a huge and significant value. So again, these are all things that we look at and take into consider. There's no doubt, though, on the horizon, 2025, we've got good things ahead of us, good opportunities. And so I want to encourage you in that, but don't be overly optimistic about how rates are going to go down. And it's not going to happen that quickly. We're going to see a much slower process. So Have a blessed and victorious week, for this is the week God has ordained for you.